Welcome back to The Explainer, everyone. Today we're taking a deep, investigative look into one of the most fascinating and, honestly, devastating events in recent DeFi history. We're going to unpack a massive crypto collapse step by step to uncover what actually happened behind the scenes. And more importantly, we're extracting the crucial financial lessons from this disaster so you can protect your own portfolio going forward.
Okay, let's dive into this, because the stakes here were absolutely astronomical. Have you ever heard of a project that promised to build an entirely new financial civilization? Well, the Origin Protocol and its native token, LGNS, did exactly that. They pitched themselves as this revolutionary leap forward for decentralized finance, eventually hitting a peak market cap of over $2 billion. So the big question we have to ask is, was this an actual financial utopia, or just a cleverly disguised $2 billion illusion? Let's look at the evidence.
Section 1. The billion-dollar illusion. Grand promises versus harsh reality.
So, Origin pitched this incredibly ambitious ecosystem to the market. At its core, they claimed to have an algorithmic non-stable coin, basically a really complex digital token that was supposedly designed to stay stable when you needed it to, but also somehow magically grow in value over time. On top of that, they promised a privacy-focused payment engine and this one-to-one asset reserve anchored issuance to guarantee security. Promoters were everywhere boasting about a fully developed ecosystem with over 2.16 million user addresses, a massive $1 billion treasury, and over $121 million in ready liquidity. On paper, it sounded flawless.
Now, what's really interesting about this slide is the jarring contrast between their marketing and the unarguable on-chain data. Promoters were shouting from the rooftops that the project was 100% decentralized. No admin, no overall owner. But when analysts actually dug in and checked the blockchain, the top 10 wallets controlled a staggering 99% of all the tokens. In a space that's entirely built on the promise of decentralization, this wasn't decentralized at all. It was absolute centralized control.
Section 2. Anatomy of a crash. The relentless drop.
Let's just walk through this timeline using data from CoinMarketCap. At its absolute peak, back in April of 2024, a single LGNS token was trading at $84.37. But then the bottom fell out. By the end of 2024, it had suffered a relentless 73% drop. In 2025, it plunged another 55%. And by May of 2026, it was sitting at under $4 a token. The crucial takeaway here is that this wasn't just some normal market volatility. It was a complete, total, multi-year collapse.
A 95.58% wipeout. Just to put that into perspective for a second, if you had invested $100 at the absolute peak, today you'd be left with just enough to buy a cheap cup of coffee. It's a staggering erasure of wealth. So, what actually triggered this catastrophe behind closed doors?
Section 3. Red Flags and Audits. Uncovering the Truth.
Right. So a security firm called Suratech found some genuinely terrifying flaws during an audit of Origin's smart contracts, which is basically the automated code that runs the whole platform. The audit essentially proved that user funds were never ever safe. A single admin could literally push a button and drain the entire treasury. The original developer could just regain total project control at any time. The code even allowed for arbitrary fee changes, meaning they could quietly siphon off user funds whenever they wanted. And to make matters worse, the smart contracts were completely unverified and the entire dev team was strictly anonymous. Absolutely zero accountability.
These overwhelming red flags led investigators to a pretty dark conclusion. In a really deep investigative piece, journalist Danny Dirac didn't mince words, explicitly calling Origin a tech-wrapped Ponzi cult. He basically alleged that this wasn't just a token that failed because of tough market conditions, but a deliberately designed, sophisticated scam right from day one.
And here's the actual mechanism that was driving Origin's so-called growth. It wasn't genuine tech adoption at all, folks. It was a textbook, multi-level marketing pyramid scheme. Users literally had to donate their own crypto just to enter the system. Then, they were heavily pressured to recruit new users so they could climb these bizarre, almost cult-like ranks. They were literally calling themselves a believer or a master, and your reward for moving up? You earned a direct cut of the money your new recruits brought in. It was an illusion, sustained entirely by new money flowing in at the bottom.
Section 4. Catching a falling knife. The danger of buying the dip.
Knowing everything we've just talked about, you have to wonder, why do people still pour their hard-earned money into rapidly collapsing assets?
Well, it happens because of a super dangerous temptation known as trying to catch a falling knife. As defined here, a falling knife is a significant, rapid drop in an asset's price driven by negative news, panic selling, or poor earnings. It's a severe warning in the investing world. Never catch a falling knife. Trying to buy into a steep decline just because an asset looks historically cheap is incredibly risky. Because trying to guess the exact bottom, it usually just leads to immediate and really severe financial losses.
Using current Coinpedia data, we can see technical indicators like the 50-day and 200-day simple moving averages. Think of these as lines tracking the asset's recent momentum. Right now, they're flashing massive, bearish signals. And even though another indicator, the RSI, suggests the asset is technically oversold, meaning it's dumped really hard, this relentless downward momentum proves a pretty scary point. Just because an algorithm says something is oversold doesn't mean it won't just keep plummeting.
And this is exactly how analysts view the future of this specific falling knife. A 2026 price probability analysis from the exchange Bitrue calculates a 40% chance of a bear case, meaning even further decline, and a 40% chance of a base case, which means prolonged stagnation. That is an 80% probability of either losing even more money or just having your capital trapped, doing absolutely nothing. Those are terrible odds for anyone trying to buy the dip.
Section 5. Escaping the value trap, when cheap is an illusion.
Beyond the rapid plunge of a falling knife, there's an even longer-term psychological hazard, the trap of anchoring your expectations to an asset's past all-time highs. We call this a value trap. It's an asset that appears incredibly cheap based on traditional valuation metrics, but in reality, it's a business or project in terminal decline. Investors get badly burned because they incorrectly fixate on the asset's successful past, while completely ignoring the fact that the underlying business model is fundamentally broken. The broader market is pricing in a bleak future, while the investor is basically buying a mirage.
To protect yourself, you really need a survival checklist. You want to look out for declining profit margins and heavy, unmanageable debt loads. Watch for mass institutional investor exits. The smart money leaving the room. Another major warning sign is a lack of genuine innovation or R&D. If the core market is shrinking and they're just treading water, you're looking at what we call a melting ice cube business model. It might still exist today, but eventually there will be nothing left.
There's a classic investing adage that's honestly the perfect antidote to value traps. Earnings are an opinion, but cash is a fact. In the crypto world especially, hype and unverified algorithms are just an opinion. Transparent, on-chain fundamentals, those are a fact. You always have to look for solid, verifiable reality rather than carefully crafted marketing illusions.
Which leaves us with this final vital thought. The collapse of Origin from a $2 billion dream to a 95% nightmare is the ultimate cautionary tale. In a market that's constantly overflowing with complex tech and deafening hype, how will you evaluate your next investment? Will you be lured in by the illusion of a massive discount, or will you actively look for the red flags of falling knives and value traps? Because honestly, the difference between the two is the absolute key to your long-term financial survival. Thanks so much for joining me on this explainer, and always keep questioning what you see on the charts.